Welcome to the Return on Lifestyle podcast with Rey Descalso from Privada Wealth Management. In this podcast, we help you overcome financial worries and make sense of planning, investing, insurance, and banking. Join us for this journey as Rey draws from his expertise and interviews brilliant minds to help you enjoy life. The best is yet to come.
Hello and welcome to Return on Lifestyle with Rey Descalso from Privada Wealth Management. Today, Rey has brought in a special guest, and that is Jared, and I am going to let Rey introduce Jared. Good morning, gentlemen. How are you?
Doing well.
Doing great. Thank you.
Yeah. We're very excited to have Jared here now. Jared is going to be new to the podcast, but he's not new to Privada Wealth Management. He's been with us. How long have you been here now in the hallowed halls of Privada Wealth Management?
Since May of 2017.
All right, so we're coming up on your 2-year anniversary. We'll have to celebrate that with much fanfare, man.
And a cake. Get a cake.
And a cake, yes, and candles and all. You know how we do here at Privada Wealth Management. Well, I wanted to have Jared on, Eric, because he and I, we have these amazing conversations where we solve the problems of the world. One of the great things about having our team here at Privada Wealth Management is, you're able to bounce ideas off each other. You're also able to, say, here's an idea that I've got. Here's a concern that I have. Tell me, what are my blind spots? Yeah. And so having a team of advisors and working with a team of advisors has that synergy, where the 1 + 1 = 3. Interesting story, by the way. I read that book, 7 Habits. And one of the things he talks about with synergy is where one horse can pull, X number of pounds, let's say 3,000 pounds on a cart. That's as much as it can do. Mm-hmm. So you would think logistically, or not logistically, but logically, you would think that 2 horses could carry twice as much, but it's not how it works. It's 2.5, 3 times as much.
Wow.
And I think there's something to be said for that. I don't know why that is. Maybe they're competitive. Maybe they're thinking, I don't want to let the other horse down. But I think there's something to be said for that. And so I wanted to introduce Jared to the podcast because we'll have him on again, depending on how you do, by the way. No pressure.
We're judging from this point on right now.
Right. This is like, The Voice, but, this is like America's Got Talent. I might hit a buzzer. This is really going poorly. And what's interesting about Jared is he comes to us from, he was a client first. That's how I know him.
Nice.
We actually, we went to the same church together where his father was the pastor of the church and I was the associate pastor. And so I was basically what Jared is to me, I was to his father, and we would have these same kind of conversations on a different topic. And so now the roles have reversed a bit, but that same synergy is happening. So Jared, let me ask you a question. Were you so inspired by my financial advice that you said, I want to get into this business? Tell me, is that exactly how it happened? I'm nodding, by the way. I'm giving you a cue.
Yes, right.
Visual
That's
cues
exactly
on podcast.
I have that effect on my clients. Actually, I don't. This has never happened before. So tell me, what was it that said, hey, this is something that I'd like to see myself getting into?
Well, first off, thanks for having me on. Well, first off, I came from the film industry. So the way it works in the film industry is you have a lot of downtime. You go from commercial, maybe have a week off, go do a movie for a month, then have a month off. So I had a lot of downtime. Always been interested in the stock market and just wanted to try it myself. So started studying, doing stuff like that, and the rest is history.
Right. So I get a phone call, and he shares with me his interests and so forth. And I thought, well, that's great. But everybody has an interest. And a lot of folks, they saw Wolf of Wall Street, or they saw something that could be Trading Places with Eddie Murphy. I don't know. So I get a phone call like that probably about once a year from somebody who's like, hey, I think this will be really cool. And as I've shared with you, the stock market is probably, or investing is probably a third of what we do, in the sense that the stock market and investing in the stock market is a third of financial planning,
Yes.
And so we talked a little bit about that. And quite frankly, I thought, well, that's great. He's got a hobby. I'm not going to hear from him. And so my side of the story, the truth of the story is, I said, look, I would, if you're honestly serious about this, here's what you got to do to get into the business, and we'll take you on. Let's do this. And so what you have to do is you have to take this test. And Eric, I figured that'll take care of that.
Yeah, because it's not an easy test. It's not like it's choose your own adventure, or pick one of three options, and then you can pass if you guess right. It's pretty rigorous stuff he's having to do.
Yeah, it is. And so maybe, I don't know, 2-3 months later, he calls me back and goes, hey, I passed the test. And I'm like, all right, well, I guess here we go kind of thing. And that was, as you said, almost 2 years ago now. And one of the things that I like about it, and you should know, you're continuing your studies. So you haven't just stopped with some of your initial licensing studies for life insurance and for the series where you're a registered investment advisor. You're furthering your studies. What are you doing now?
So I'm currently working on the CMT designation, which is Chartered Market Technician, and I've completed level 1 and sit for level 2 in June.
Excellent.
So yeah,
excellent. And level 1, how many levels are there? First off,
3.
There's 3 levels, and so you finish level 1. How long did the level 1 test take you? How much time do you have to take that test when you actually sit for it?
Oh wow. I believe it was 2 hours, and then level 2 is, I believe, 4 hours. I should know this stuff, but I don't.
Wow, that's long.
Right. And then level 3, what do you got to do for level 3?
I believe it's similar, 4 or 5 hours. So yeah.
Wow. So they mercifully break it up for you.
Yeah.
And then once you pass level 3, you get your designation. You're a chartered market technician.
Oh, then there's a few other steps, getting sponsorship and stuff like that.
Yeah,
but
yeah.
For the most part, yes.
So it's a pretty big deal. And why the CMT versus any other one of the designations? What do you like about it so far, and what drew you to it?
So it fits my personality a little more. I like the technical, quantitative side of the business,
right.
And the CFA is more balance sheets, fundamentals, whereas this, fit my personality well.
Yeah.
So.
And for those of you playing at home, one of the things we talked about in a previous podcast is about investing like you drive, where you have indicators telling you, are we going to put our foot on the gas or are we going to put our foot on the brake? And one of the things that we feel is that the technical indicators give us an unemotional, mechanical, rational, reproducible, repeatable way of making decisions. Now, there's nothing wrong with balance sheets. There's nothing wrong with fundamentals.
No, absolutely not.
Right. And one of the things that I think, one of the conversations that we've had is it drives us nuts when we turn on CNBC or we go on Twitter and we see people who do what we do, and analysts and technicians, and they'll just trash Warren Buffett. Like Warren Buffett, he doesn't know what he's doing. You're just like, what are you talking about? So technicians, people who are nerds for numbers and price action. And likewise, people will look at technicians and say, oh, you think a chart's going to tell you the future. You guys are nuts. It's more important to look at GDP and macroeconomics. And everybody likes to put everybody else down. And here, this is a safe space. Privada Wealth Management, we believe that we truly, and we've had this conversation, we believe that you have to take the best of everything and have sort of a mixed martial arts approach and say, this works now. But obviously, technical analysis is the foundation because price doesn't lie. And with Enron, or any company, there can be a little bit of a fudging of the numbers, and that may not come out. And if and when it does, fine, the price will react. And the price will tell us what's going on. So, well, good. Well, glad to have you on board. Another thing that just I can brag on you a little bit, Eric, I know you're a huge fan of our blog as well, not just the podcast.
Absolutely.
Yeah, exactly. Sometimes you read it at night to fall asleep, I'm sure. Recently, Jared just published a blog, and I really liked it. It went up over, I think, on Friday, and I was reading it over the weekend. I thought, this is kind of it's a great blog, but what's interesting about this particular blog, we're going to use it as a conversation piece in a moment, but he was also picked up with another blog by Fox Business News, and we can provide that link to you. I don't have it handy. Yeah. So our blog has been picked up. Or his entry in our blog was picked up by Fox Business News because he's taking these technical, nerdy, chartered market technician student notes, and he's trying to translate it to where the rest of us can kind of grasp it, and that's something that we believe is important, and we believe it sets us apart. And so I want to have him on board here and kind of go over a few things, some of the quotes that he has found inspiring. So the blog that went up on Friday, he talked about some of the quotes that were inspiring to him, and I'm going to read them to you. And I'd like to hear from Jared why it is important to him, and kind of pepper him with some questions and then add my own 2 cents. One of the ones that I like from the blog was by John Maynard Keynes. Now, I don't like John Maynard Keynes, by the way. I'm not saying everything he says is wrong, but he's a if you read my blog, and don't worry, nobody does, my biggest gripe is always with the Federal Reserve. And John Maynard Keynes is a Keynesian. Yeah. So his thing was, if you print more money, then Eric and Ray will have more money to spend, and then everybody's going to be in a good mood, and it's all about being in a good mood. That's definitely not a technical description of Keynesian philosophy or economics. But he did say something that you quoted, and I do think it's true, and I think it's important for us to touch on. It says, markets can remain irrational longer than you can remain solvent. What does that mean to you? And unpack that for me, Jared.
I would just say you need to be careful. If you think of the person, say, back in 2008 as the market's going down, if you don't think the market can go lower, then you're mistaken. And same the other way, if you don't think the market can go higher, it obviously can. You can't stay solvent during that whole time if you're betting against it.
If you're wrong.
Yeah, exactly.
Yeah. And I would say, when I read that, my problem has never been that I'm unaware of the bear, so to speak, or I'm Mr. Permabull. That's never been my problem. My problem is believing that this bull is going to keep going. And as a financial advisor, I have to realize that, man, the market makes no sense, in the sense. Well, let me give you a couple examples. First of all, in 2009, March of 2009, which we just had the 10-year anniversary of the bottom of the market, who would have thought on March or April even now in 2009, 10 years ago, that the worst is over? The bull market has begun.
Yeah, definitely not me.
No. One of the things I was sharing with you is I was in a beach on vacation, and the S&P touched 666. I'm a former minister, so the number 666 has a little bit more meaning. And I thought, well, maybe I should not have left the ministry because the end is nigh, And that being said, it was amazing. And now we're 10 years later, and I hear people talking about this, the bull market has got to end.
It doesn't have to.
Right. It doesn't have to. There's no rational, I shouldn't say that. We can come up with reasons why. And this is important, I think. This is something that Jared has kind of made clear to me. You can always make an argument for the economy and the stock market and the bond market and every other market that's attached. You can make an argument for it going up, and you can make an argument for going down. And I think if you can't, then you're the sucker. In other words, if you're in a room, and you don't know who the joke is on, I got bad news for you, Jared. The joke's on you, And I think if you can't make an argument for the next recession, and you can't make an argument for the next boom, then you really haven't analyzed the data well enough.
I'd agree. Definitely.
Yeah. One of the things that a quote that you have in here is by Paul Tudor Jones. By the way, who is Paul Tudor Jones? I didn't Google that ahead of time.
He's a hedge fund manager.
Is he good?
Well known. Called the 1987 crash.
Really?
So yeah.
Nice. So this guy called it.
Yeah, he was positioned correctly going into it. So,
nice. Is he still around?
Yeah.
Do you have his number by any chance? I'd like to speak with him.
I'll reach out to him. I'll let you know.
Put a good word in for me. He said, every day I assume every position I have is wrong. And I think that's something, the blind spot. A lot of people don't realize. And that's one of the things I like having you and Steve and Barb here on staff to say, hey, where's the blind spot?
Absolutely.
As you were investing and learning it, any blind spots that became aware of as you have been studying and in the business for the last couple of years?
Yes, I would say hindsight being one of them. Everything looks easy in hindsight, but it's definitely not in real time. Yeah. And today, it's April, and we're looking back at Q4. And Q4 of 2018. Now, everybody's like, oh yeah, that
that totally makes sense. If there's going to be a trade war with China, then naturally Apple's not going to do well. And if Apple doesn't do, and we like to kind of tell those stories about market action and so forth. And that's kind of an example, I think, sometimes of how we fool ourselves. The other one I'll say about that is, too, about not just hindsight, but I don't know what you would call this. I don't know if it's hindsight per se. It's more like just picking your winners. Whenever you talk to people, they always talk about the great decisions that they made.
Very true.
Which are, and I think oftentimes what you need to look at, not just in investing, but in your financial life, what are the bad decisions that you made? And what caused me to get fooled, or what caused me to be blinded by it. So,
I would also add, I think you learn more from the bad decisions versus the good decisions. There's more lessons in there. So.
Yeah, for sure. One of the quotes is by Peter Lynch, and he says, "Everyone has the brain power to make money in stocks. Not everyone has the stomach." Why did you throw that up on the blog?
There's a lot of people with the buy and hold type strategy. They say, okay, yeah, I'd be fine with my portfolio being down 50%. Well, when the portfolio is actually down 50%, I don't think you'd probably feel the same way.
Yeah.
So
yeah. I think that's one of the reasons why first of all, with technical analysis, let me give you another example, actually. With technical analysis, when the pullback happened in January and February of 2018, technical analysis was not as worried as perhaps John Q. Public was. I know when the volatility hit us in late January, early February, I was not happy because I don't have a great stomach for volatility. Even though I'm in this business, I don't like it. I don't know many people who do. But what was interesting is that technical indicators, and specifically some of the conversations we had, said, well, if you look at all of 2017 with zero volatility, we were kind of due.
Absolutely.
Right.
Yeah.
Going back to the weather analogy, I shouldn't be surprised when after 10 years of no hurricanes here in Florida, we're going to get a couple good ones. We're kind of due, And so that's something where it's the stomach makes it is really where you get success. Going back to your 50% thing, if you can't go down 50%, then that portion of your investment shouldn't be in stocks, right?
Correct.
And of course, we are going to try our very best using the techniques we've talked about, whether it be diversification or technical indicators, to not be down 50%. But that's a conversation people have to have, and they have to have a certain kind of a comfort level with that. Now, let me ask you another question real quick on that. Oftentimes, your stomach, the emotion, it makes you do the wrong thing. And so for me, when it was going back now to April of 2009, the problem is the time that I let lapse, after a big bear market like that, the time that you lose is something you can't get back. And that was one of the things for me that I realized that I've got to find a better way to make decisions. And those decisions have to not be based upon emotion, because there's another bias. And we're going to do, at some point, we're going to do a series on biases in investing, and fallacies in investing. And one of the ones that it comes up again is recency bias.
Yes.
And I'm kind of frightened by what a good mood I am in when I come to work, because it's been pretty good, Q4 notwithstanding of 2018. And I think that's the other thing that is a little bit bothering me right now, is that we've had so much, again, the market can be irrational for a very long time. But we've got to say we could be wrong about this. Our good mood could be unfounded, and we have to question it. And that's kind of what keeps me up at night right now, is the fact that not everybody, but too many people, myself included, enjoy investing.
Yeah.
And the other thing that I'm noticing is that there's more do-it-yourselfers out there, more people who, and this is completely anecdotal, but more folks are like, well, buy and hold, and we'll just get a couple index funds and hunky-dory, And that's the other thing that's an indicator for me, outside of actual technical indication, is sort of that sentiment seems to be on the positive side. Have you seen any studies on sentiment recently?
I've seen quite a lot. None that really stick out other than just what you're talking about. Optimism is really high currently. Yeah. Which tends to be kind of a negative short-term indicator. You'd expect a pullback. Yeah. Not necessarily, it doesn't have to happen. It's just that could happen.
Good moods, ironically, are a red flag. in this type of a business, and in the business where we're looking at portfolios with the idea that we're trying to get people to get through retirement. And the one thing that you said to me the other day is it's not trying to beat the index. We're not trying to beat the S&P 500 to prove our worth. We're trying to help the client to stay with a plan.
Yes.
And so that's where the technical indicators, that's where portfolio management, because the benchmark is not the NASDAQ. The benchmark is the client, to help them hit their benchmarks, which is an income, which is getting their financial plan from beginning to end. And we're going to have you back again, and we're going to talk a little bit more about portfolio management, a little bit more about some of the nerdy stuff that you're learning. I'm going to have you in as well regarding when we start talking about biases and when we start talking about fallacies and that type of thing. But right now, what we'll do is we'll wrap this up. There's a lot more for us to talk about, but we don't want to give all away all our secrets in just one podcast. So Eric, we'll turn it back to you, sir.
Oh, fantastic. Hey, I want to touch back on the whole blog thing. You know, Ray, you've spoken many times about how much money I made in my hobby of creating paper mache My Little Pony outfits. Right. And so the millions and millions of dollars that I've made from that, I hired Sam Elliott to speak your blogs to me to help me sleep.
Oh, wow.
So yeah. So I mean, to me it's a win a kind of scenario. But that got me thinking about Sam Elliott. And I just like the guy, and I'm not going to try to imitate his voice because it's just iconic. But I will do a quote, since today is all about quotes. This is something that I thought about with you, Ray, specifically, and Privada Wealth Management. I think this completely fits both you and I, and obviously Jared as well. And so here's his quote. I think anytime you can affect people in general in a positive way, then you're a lucky individual. I think that's a great quote. And I think that's kind of what you guys live by. And I love that about Privada Wealth Management. I love that about working with you, Ray. And I appreciate you bringing in Jared.
Nice.
Thank you for having me.
All right. Thank you for all listening to the Return on Lifestyle podcast with Rey Descalso. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Ray comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. And I would like to have you share Ray's blog and maybe Jared's blog as well. Ray, can we get a link or something for the listeners to be able to reach out and get your blog?
You bet. You can actually find both Jared and I on the same blog, and it's our website, privadawealth.com/blog.
Fantastic. Again, thanks for listening today. For everyone at Privada Wealth Management, this is Eric Johnson reminding you to live your best day every day. We'll see you next time.
Thank you for listening to the Return on Lifestyle podcast. Click the subscribe button below to be notified when new episodes become available. Posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Privada Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider for any questions you may have regarding your investment planning. The following program is sponsored by Privada Wealth Management, which is solely responsible for its content. Securities offered through J.W. Cole, financial member FINRA, SIPC. Investment advice advisors are unaffiliated entities. The opinions expressed by Rey Descalso should not be construed as specific investment, legal, or tax advice. All economic and performance information is historical and not indicative of future results. Investing may involve the risk of loss of principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax penalties that may be imposed on such person, and each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. Rey Descalso is not providing legal or tax advice. Nothing should be construed as solicitation of an offer to buy securities. The preceding program is sponsored by Privada Wealth Management, which is solely responsible for its content.